Are you starting to think about retirement? Before you do, we are going to share the three main mistakes that you should be avoiding to optimize your taxes and have an independent retirement. Let's go. One of the first mistakes that we see with many clients is like, well, they had been saving their entire life. And in a way, well, these are your last year to maximize out your contributions. So one of the things that you can do is try to keep contributing a little bit more to your retirement plan. Remember, when you stop working, you're not going to be able to keep contributing to your retirement plan because you don't have a work anymore, you don't have a business maybe you have some incomes from, I don't know, a rent or maybe your portfolio, but with those kind of income, you're not going to be able to contribute to your 401k. So one of the things that the IRS allows you is something that is called the catch-up contribution. For example, in a 401k, you're going to be able to contribute up to $23,000 per year. But if you're over 50 years, you're going to be also being able to contribute $17,500 more. So your entire contribution could go around those more than $30,000 per year. So these are numbers for 2024. They change every year. But for example, also if you have a 401k, an IRA account, you're going to be able to contribute $7,000 per year. But if you're over 50 years old, you're going to be able to contribute $1,000 more. So if we add these numbers, you're going to be able to contribute up to $8,000. One of the other mistakes that I see with many clients is like, well, they only contribute to your 401k or maybe to the IRA, but sometimes they have the chance to have a health saving account, and sometimes you're not contributing to those accounts. Those accounts work wonderfully because they have what we call the three superpower. The first one is when you contribute to one of these accounts, you're going to be able to subtract from your taxes the amount that you're contributing. The second one, while your money is there in this health saving account, well, your money is going to grow, not paying taxes what is there. And the third superpower is going to be when you withdraw the money and that money is for qualified medical expenses, you're not going to pay taxes on that. So the end of this game will be like in these last years, try to contribute as much as you can because then you're not going to be able to, and maybe you're going to really need that money in the future. The second mistake that we see very often is you don't know what is a Roth conversion, or maybe you have heard about RMDs, requirement minimal distributions, but maybe you just said, well, it's something that is going to come. I'm not going to be able to do anything. And here's, well, where you can start to optimize your taxes on. Let's see it like this. While you're working, your tax bracket should be really high in a way because we are producing some money. But then when you stop working, well, your tax bracket is going to be lower for a few years. But then Uncle Sam is going to tell you, well, I give you the chance, I have given you for all these years the chance to be saving, to save in a retirement plan. You have not been taxes for the money that you put in the retirement plan and for the money that it has been growing there. But now it's time for you to start paying some taxes because I'm going to ask you to withdraw that money even though that you don't want it. And when the IRS is going to ask you about that? Well, if you were born between 1951 and 1960, well, the IRS is going to ask you for these required minimum distributions or withdrawals from your retirement plan when you are about 73 years old. So when you get to 73 years old, you're going to start withdrawing money from your retirement plan, even though that you don't want it. And also, if you were born after 1960, then you're going to have start this requirement minimum distribution when you are 75 years old. So one good strategy that you can implement is, as I said, maybe you're retiring at 67 until 73, you're gonna be in this lower tax bracket. So you can start withdrawing some money from your retirement plan for all these years, and you can even convert, take that money to a Roth IRA, where it will keep growing there. Of course that you're gonna pay taxes for the money that you're taking out, but remember that you're gonna be in one of your lower tax bracket in time. So in that way, what you're doing is lowering also the balance that you have to withdraw when you're 73 or 75 years old. So in this way, you're optimizing your tax bracket. Withdraw some money all the years when you're in this lower tax bracket, so the balance will be lower, and then you're not going to be withdrawing so much money when you're over 73 or 75, because you don't want to be paying more taxes when you're 80 than when you are currently or actively working. And now let's go for the last mistake that we see usually our clients are having in time. The third one will be, maybe you have a 401k, a traditional 401k, or just an IRA, a traditional IRA, or you rolled over your assets to a traditional IRA, and you also have a Roth IRA. But then you have been saving your entire life. You have been accumulating assets, but now maybe you're not working anymore because you just retire, and now you have two different accounts and said, from where I should be withdrawing money first, because maybe you're receiving your social security check, but sometimes that's not enough to support the same lifestyle that you have been while you were working. And maybe in these times now it's time for you to travel or to do other kind of things that you have been waiting for your retirement to start. So you need to withdraw some money from your retirement accounts. And there are so many different theories. It's just like, maybe start with the Roth, maybe start with the traditional, maybe just split and take a little bit from each one of those. But as a general rule of thumb, I'm not considering in this example that you have other kind of incomes from other sources, but the best rule of thumb here will be, leave the Roth IRA. Try not to take money from that one. Start with your 401k, your traditional 401k, or your IRA, and start withdrawing money from that account. Because remember, the Roth IRA is an account from where you already pay taxes on. We could say that that's a tax-free account, and your money is going to be growing tax-free. So in the other account, in the traditional one, the 401k or the IRA, the IRS is going to tell you, as we saw it, you need to start withdrawing money. And when you start withdrawing money, you have to pay taxes on that. So it will be much better for you to start with that 401k and leave the Roth 401k or the Roth IRA. Leave it to the end. Try to not to withdraw money from that one. Start with the other one. So now you know the three main mistakes that before retirement you should be avoiding to optimize your taxes. If you like this video, please give us a like so other people could avoid having these kind of mistakes. If you feel that you would like to have your particular situation reviewed it, remember that in Advice Financial we provide hourly financial planning and we can review your particular case. Thank you.